Hello everyone, financial reporting. So we have covered the complete syllabus. Now we are just practicing some questions from past papers from our BPP kit. So let's cover one more good question from our BPP kit, that is a Loudon company. This question was appeared in 2020. So let's see what's the requirement. There are two requirements of this question, requirement A for 8 marks and requirement B for 12 good marks. First requirement A. Prepare a schedule of adjustments required to the retained earning. We need to prepare schedule of adjustment required to the retained earning of Loudon Company at 30th September 20x8 as a result of information in note 124. Mean there is some information from note 1, 2, 3, 4. According to that, we need to prepare schedule of adjustment to the retained earning. Mean what adjustments are required to the retained earning that we need to prepare. Mean we need to prepare, calculate revised retained earning as per adjustment of 1 to 4. This is for 8 marks. Year end is 30th September 20x8. If year end is 30th September 20x8, this means this year was started from 1st October 20x7 and ending on 30th September 20x8. If year end is 31st December, student can judge easily, okay, 1st January till 31st December. But if year end is suppose March, 31st March, year end is 30th June, year end is 30th September, in that student sometimes confused. So if year end is other than December, I will suggest at start of the question or in the question, please write down like this when this year was started and when it is going to end. Because through writing down this, it will be fixed into your mind. Okay, this is the year end, started at this date and ending on this date. This means started in 27 October and ending on 30th September 20x8. Okay, so we need to calculate revised retained earning according to the adjustment. And part B, prepare the statement of financial position of London company as at 30th September 20x8, and we need to prepare balance sheet as at 30th September 20x8. The notes to the statements of financial position are not required. All calculations should be rounded to nearest $1,000. So let's see. So we need to prepare schedule of adjustment to retained earnings. Okay. Loudon Company has extracted a draft statement of profit or loss for the year ended 30th September 20x8. Draft means that is not finalized. Draft means not finalized. Mean there are some adjustment that need to be made. Draft means not final, mean there are some adjustment that need to be made. Means still we need to adjust some entries. So Loudon Company has extracted a draft statement of profit or loss for the year ended 30th September 20x8 before any adjustments required by note 124 below. Mean they produce profit and loss before these adjustment 1, 2, 3, 4, mean these are not adjusted. That's why they have asked us to adjust this. From the accounting software, the draft profit has been added to retained earning and a profit from profit and loss has been added to retained earning and summarized trial balance of Loudon Company at 30th September 20x8 is given below. Mean this is a trial balance given below. And in this trial balance, there is a figure for retained earning in that these adjustments are still needed to make impact. Mean these adjustments are not adjusted. Okay, let's see what's the trial balance. Equity share capital is given for 10,000, mean 10 million. Retained earning as at 30th September 2028 draft mean not a final. Balance is 4122 in which we need to adjust amounts relating to these notes 1 to 4. Then we will be able to calculate drafted, redrafted, retained earning. Office building at cost. What is office building? Asset. Factories cost on 1st October 2027 means start of the year, 40,000 non-current asset. Office building accumulated depreciation at start of year is 4,000. Factories accumulated depreciation as 1st October 2027 is 11,100. So through this, we can calculate carrying value at start of year. Environmental provision at start of the year was 1,228. Current liabilities total is given 34,500. Current assets total is given 14,700. Proceed of 5% loan note mean non-current liability 5,000. Deferred tax liability of 1,500. Interest paid during the year 250 expense. And there is the balance of suspense account 3,500 and how they tally the trial balance debit and credit side. Okay. So what we need to do, we need to calculate the schedule of adjustment to retained earning. So part A, schedule of adjustments to retained earnings. I am solving this question on board, but you need to solve this question in Excel. It's better if you practice on Excel so that you can easily attempt these kind of question in exam paper Excel sheet. So schedule of adjustment to retained earning and retained earning, we are having how much draft retained earning 4122. So all figures in $1,000. So draft retained earning is 4122 in which we need to adjust some adjustment. Okay, let's see what are the adjustments. Note 1. A 5% loan note was issued on 1st October 20x7. Mean at start of the year, 5% loan notes were issued. Mean company obtained loan. How? By issuing loan notes. Mean there is non-current liability that is available in balance sheet at 5 million. Okay. At its face value of a 5 million, direct cost of the issue amounted to 0.125 million and were charged to profit or loss. In these 125 million, mean 125,000 amount is charged to profit and loss. The loan will be redeemed in 5 years' time at a substantial premium, which gives an effective interest rate of interest 8%, mean 8% we need to calculate the interest. The annual repayment of 250,000 at a 5% coupon rate are paid on 30th September each year. And 250,000 annual payment is there. So this 125 is charged to profit and loss account. In fact, this 125 should be deducted from the initial amount of the loan, and with the remaining amount, initial liability should be recognized. And then we need to add the interest 8%, and we need to deduct the payments so that we can arrive at a closing figure that will be included in balance sheet. Is that? And this 125 they have shown here. In fact, interest paid, they have, interest paid, this 250, interest paid, they have shown here as expense. So if we recall our previous memory. So I'm moving towards working one that is relating to loan notes. How to prepare the working initial. In that initial, we add what? Interest, and we deduct what? Payment. So we arrive at closing liability. If you see, the initial amount will be this 5 million minus 125. 5 million, if we see 5 million will be 5,000. So 5,000 minus 125, what will be the amount? That will be 4875. On this 4875, we need to charge interest at effective rate. What is effective rate? That is 8%. So at 8%, so calculate 8% of this amount, 4875 into 0.08, that is 390. That is 390. And from this, we deduct the payment, and payment they have made 250. So what is a closing liability here? 4875 plus 390 minus 250. So it is 5015. Can you understand this? Now, what adjustment should be made to retain earning? Obviously, for this year, the interest expense is this one that we should have been recorded in P&L. And if it is not recorded, obviously this interest will reduce the profit as well as retained earnings. So from retained earning, we need to reduce this. And this that was wrongly recorded in P&L, we need to add back because it was retained from profit recorded as expense. Now we need to add back this. So these two things adjusted to will be adjusted to what? Retained earning. And in balance sheet, we will record the loan note liability with this amount. Can you understand this? So first we will adjust what? Add back. What we are going to add back? This 125, what is that? Direct cost of loan note. What is that? 125. And the less what? Finance cost or interest. That is through working one. How much was that? 390. Yes, 390 we need to deduct because it was not recorded as expense, as profit for the current year is charged to add it to retained earning. So now we are making adjustment with the retained earning. Whatever should be adjusted with the profit, we are adjusted with the retained earning. So for note one, we have done. So in balance sheet, this figure will go as a non-current liability. Okay. Note two. London company acquired an office building for 20 million on 1st October 20x2. If we see the building, office building cost is 20,000. Obviously, they acquired on 1st October 20x2, and its cumulative depreciation is 4,000 at start of the year. So what we need to do, we need to start working to here. That is about non-current assets. And first they are talking about building. So building cost was what? How much was cost? 20,000 and accumulated depreciation at start of the year 4,000. So cost 20,000 and accumulated depreciation at 1st October 20x7 was 4,000. So this means carrying value at 1st October 20x7 is what? 16,000. Now we need to see what happened during the year. Okay, so an office building for 20 million 1st October with an estimated useful life of 25 years and life was 25 years. Taxation is charged on a pro rata basis, mean according to month. On 1st April 20x8, mean during the year. Year started on 1st October. So on 1st April 20x8 mean after October, November, December, January, February, March mean after 6 months. The building was deemed to be impaired as its fair value was estimated to be 12 million. Its fair value is what? 12 million. So we need to compare carrying value with the fair value, not a fair value. We need to compare carrying value with the recoverable amount. Recoverable amount mean higher of a fair value or value in use. But they are saying on 1st April, the building was deemed to be impaired at its fair value was estimated to be 12 million. At that date, the estimated remaining life was revised to 12 million and life remained 12 million. Ignore the deferred tax consequences of this revaluation. And Loud company has 10 factory. From here, there is information of factories. This means we need to record the impairment loss, but before recording impairment loss, we need to calculate its carrying value at the time of impairment. When it is going to impair on 1st April 20x5. Its life is 25 years. This means till 1st April, we need to calculate the depreciation. So depreciation on 1st April 20x8, how to calculate this depreciation? It's how to calculate this depreciation? Its cost was 20,000 and 25 year is the life. So 20,000 divided by 25 years. So we will be able to calculate a per year depreciation, but we need to charge from 1st October till 1st April. How much? 6 months. So multiply by 6 by 12. Can you calculate depreciation? Gives 20,000 by 25 into 6 by 12. That is what? 400. And by deducting this 400, we will be able to calculate carrying value at 1st April 20x8. And that is what? 15,600. Mean at 1st April, when we need to record impairment, its carrying value is 15,600. And now they are saying it's a estimated fair value is a 12 million. The remaining is impairment loss. So fair value is what? 12 million, mean 12,000. So can you please calculate the balancing figure that is impairment loss? What's that? 15,600 minus 12,000, that is 3,600 should have been deducted as impairment loss. This means on 1st April, its fair value also mean carrying value is 12,000, and on this 12,000 we need to charge depreciation for the remaining months of 20x8, and a remaining month depreciation, its life is 12 years. So how we can charge depreciation? At depreciation at 30th September 20x8. So 12 million divided by 12 years life, and remaining obviously April till September, 6 months depreciation should have been charged on this amount. What is 6 month depreciation for this amount? That is 5. So now the carrying value at 30th September 20x8 is what? 11,005. Now, what should be recorded in profit and loss account when adjusted to retained earning for this year? This 400 plus this 500 mean 900 depreciation that we need to record in P&L. And this impairment loss of 3,600 we need to record in P&L. So that should be adjusted. This figure will be recorded as property, plant and equipment building 11,500 in balance sheet. Then you understand this. So 900 we need to adjust the depreciation, and 3,600 we need to adjust the impairment. So here we go. So number 2. So we need to less what? Depreciation of building. And this we have calculated through working 2. That is what? 900, and less impairment of building. That is also from working 2. That is 36. Are you with me? Okay. Now there is more information in number 2. London company had 10 factories. And if we see, there is information about factories. Factories cost is 40,000, and its cumulative depreciation at start of the year is 11,100. So first calculate its carrying value at start of the year. So now we are moving towards factories. So cost was 40, and accumulated depreciation at 1st October X7, that is what? 1110? 1100. And we arrive at carrying value at 1st October 20x7. Can you please calculate the carrying value for me? What's that? Is 28.9. Okay. Now we need to see what happened during the year. Okay. So Loud company had 10 factories on 1st October 20x7. At start of the year, Loud company sold one of its factories with a carrying value of 3 million. The cost was 5 million. Cumulative depreciation of that property was 2 million. And they sold for 3.5 million, mean they received cash 3.5 million, but the asset on carrying value reduced by 3 million, and this adjustment is not recorded. And the proceeds were credited to suspense account, mean in suspense account, this 3,500 is relating to this receipt. So sold on 1st October, this mean we need to reduce what? Disposal at 1st October. That is what? 3 million. So the remaining carrying value is what? 25,900. Okay, we need to see what is the depreciation for the year. Is there any information? Yes. No depreciation has been charged on any non-current assets for the year ended 30th September 2028. The factories are depreciated at 15% per annum using the reducing balance method. So reducing balance is what? WDV 25,900. So depreciation for the year is 25,900 into 15%. Can you please calculate depreciation for me? That is 3,885. So what is the carrying value at 30th September 2028 that should be recorded in profit and loss in balance sheet? So that is 22015. So from here, we need to record this depreciation in profit and loss account that should be adjusted with retained earning. And this should be recorded as property, plant, and equipment with non-current assets in the balance sheet. Is that? But they sold the property. There must be some gain or loss that should also be adjusted to P&L. So we need to calculate gain or loss on disposal as well. So sale proceed. They sold for 3,500. Carrying value is 3,000. So there is 500 gain on disposal. That should also be recorded in P&L, mean adjusted to retained earnings. So retained earning, we need to adjust this depreciation and this gain on disposal, and this will be recorded as balance sheet figure. So adjust depreciation 3,885 and gain 5. So depreciation less depreciation of factories 3,885, and we need to add gain factory disposal, and both these figures we got from working so that was 500 we need to add. Are you with me? So note 1 and note 2 we have done. Now moving towards note 3. Environmental provision. Is there any information here? Yes, environmental provision with the amount of 1,228 at 1st October 2027. Loudon company has an obligation to clean up environmental damage caused at one of its factory site during 2027. And the cleanup is due to take place at the end of the factory useful life. The liability has been accounted for appropriately, and balance at October 27 represent the correct present value at that date. Obviously, we need to discount it at present value method. We need to record the environmental provision. So the capitalization and liability that is done accurately because it was relating to previous year. And Loudon company has a cost of capital of 5%, but according to this cost of capital, we need to record the finance cost according to unwinding discount. Unwinding of discount finance cost we need to record. So that we need to record here, and that will be added to the liability amount as well. Is that? So we can open working 3 here. That is relating to environmental provision. So the amount given here at 1st October, that is what? 1228. So liability at 1st October is 1228. So unwinding discount, that will be 1228 multiplied by what was the cost of capital is 5%. So what is 5% of this? What is 5% of this? 61. So closing liability. 30th September in balance sheet should be recorded with by adding these two figures and by adding what is the amount, that is 1289. So this figure will be recorded in balance sheet as a liability, and this should be recorded as finance cost, means should be adjusted, means should be deducted from retained earning. Is that? So number 3, unwinding discount from working 3, that is what? 61 we need to deduct. Is that? So note 1, note 2, note 3 done, note 4. At 30th September 20x8, the tax written down value of property, plant and equipment was 25 million. In property, plant, equipment value was 25 million. Okay. Mean tax base is 25 million. The income tax rate applicable to Loudon company is 20%. But we need to see what is the value at 30th September. What is the value at 30th September? And value at 30th September we can find from here. How? 11,500 plus 22015. And if we add 11,500 plus 22015, that is 33515. 33515. So we are going to start working 4 here relating to deferred tax. So carrying value of property, plant and equipment in books, that is 11,500 plus 22015 is equal to 33,515, while tax base is what they are saying, the tax base is 25 million. Yes. So tax base is 25 million. So the tax difference, temporary tax difference is what? Can you calculate the difference? That is 8515. And tax rate is what? 20%. Tax rate is what? 20%. This means the deferred tax liability for the current year should be 20% of this. So tax rate is 20%. So deferred tax liability should be 85,185. 20%, what is that? 1703. There was some balance in profit and loss account. Mean what was the deferred tax liability at 1st October? That is the deferred tax liability, that is 1,500 they recorded, but actual should be 1703. So deferred tax liability as per trial balance, that is a 1500. This means the more required is 203. They recorded 1500 instead of 1703. This means 203 more liability required. This means more liability required. So this should be charged to profit and loss. And this should be recorded as balance sheet figure deferred tax liability. Instead of 1500, it should be 1703. So 203, we need to adjust deferred tax adjustment. Where? Here. So number 4, deferred tax adjustment from working for, that is what? 203 we need to deduct. So we have dealt all the note 1, 2, 3, 4. So now we can calculate adjusted retained earning, revised retained earning. Can you calculate, please? Revised retained earning. That was required. That should be recorded in balance sheet as well. So 4122 plus 125 minus 390 minus 900 minus 3600 minus 3885 plus 500 minus 61 minus 203. It is coming negative figure of 4292. No issue, we'll record a negative figure in the balance sheet. It's fine. So part A, we have done. Now moving towards part B. We need to prepare statement of financial position for this company. So moving towards part B, statement of financial position as at 30th September 20x8. And we need to record figures in $1,000. So first we record what assets, non-current assets. Under non-current assets, we are having what building, or we can add both property, plant and equipment. So property, plant and equipment value, we already calculated here total. How much was total? 33515. So 33515 that we calculated from working to. Is there any other non-current assets? No. This means we should move towards current assets. So now moving towards current assets. And current assets figure is given in the trial balance. How much is that? That is 14700. So 14700. And by adding these two, we can calculate what one side of balance sheet, that is total assets. And total asset figure is what? 48215. Now moving towards equity and liabilities. So first we will record equity. In equity, we are having a share capital that is given in the question. How much was that? 10,000. So we'll record share capital 10,000. In that, we need to adjust retained earning. And retained earnings we got from part A, and that is what? 4292 negative. So by deducting this, we are having a total equity that is 5708. In that, we need to adjust non-current liabilities. In non-current liabilities, we are having a loan notes. For loan notes, we prepare working one, that is a 5015. So this is coming from working one, 5015. And then we will move towards current liabilities. And under current liability, no, sorry, non-current liabilities, we are having environmental provision as well. How much was environmental provision closing that we calculated? That is 1289 from working three. We are having deferred tax as well. Deferred tax liability. In the deferred tax liability figure, we calculated how much it should be. 103 from working four. How much was that? 1703. Now we are having current liabilities. Current liabilities figure is given in the question, and that is what? That is what? 34,500. So we'll record current liabilities 34,500. Now please see if the total of equity and liabilities is also 48215. Please check that. 5708 plus 5015 plus 1289 plus 1703 plus 34,500. So this total, agree with this total. This means our question is accurate. So try to practice this question in Excel sheet. Hope to see you in next class with some new questions.